Welcome students. Now we are going to study about market efficiency and behavioral finance. This is unit 6. So we have seen fundamental analysis, then we have seen the technical analysis, how things we evaluate, how we take risk and discern factor, and how past data impact on the future rates in technical analysis, and how economic factors also act. But when it comes to the new theory that is called market efficiency and behavioral finance, it talks about other than the fundamental and technical analysis. It says about the behavior, how a person react to a particular information and how the information will lead to the changes in the price structure of the stock market and even in the fluctuation in the market. So first, let's study about the market efficiency, and then we will study about the random walk theory, and we will see the different forms of it. So we all know efficient market theory says that the share price fluctuations are random and do not follow any regular pattern. But when we go look at the technical analysis, let's talk about the pattern. But here the theory says it's random. The fluctuation is random, but there is no any particular regular pattern. So in this arises the question as to whether the intrinsic value of stock has any meaning or not. Okay, we have already calculated intrinsic values of the stocks, and are they related to the security prices? Will the impact on it? And if you look at the sections about the concepts, now we will understand how actually things happens and how the process of determines the security prices. And coming to the basic concepts, before understanding the theory, certain concepts and phrases like market efficiency, liquidity, traders, and information trader should be understood. So, what exactly the market efficiency is? The expectations of the investors regarding the future cash flow are translated or reflected on the share prices. That we always know. How an investor expects, okay, in the future cash flow, and those are translated or can be, you can say, reflect on its share prices. And the accuracy and the quickness in which the market translates the expectation into prices are termed as market efficiency. So how much quick he is and how accurately he is going to translate his uh, the perception, and which turn, or you can say the market actually react. And that is, for example, I'm thinking market is going to move further or a bullish trend. Okay, and I'm not just thinking it, I'm evaluating it. And that accuracy and quickness will automatically reflect on the prices, and this all situation is called as market efficiency. And we see two types of market efficiency. One is operational efficiency and one is informational efficiency. When we look at operational efficiency, a stock exchange operational efficiency is measured by factors like time taken to execute the order and the number of bad deliveries. So there things happens because everything is automatic now, and the operation efficiency is very fast. Okay, executing the order when sold, selling or purchasing, buying or selling option. So, and bad deliveries, how much happen? So investors are concerned with the operational efficiency of the market, but efficient market hypothesis does not deal with this efficiency. Okay, and coming to the informational efficiency, so it is the swiftness of the mark or the markets reactions to new information, obviously. So new information in the form of economic reports, company analysis, political statements, and announcements of new industrial policy is received by the market frequently. And how does the market react to this type of information? So we always see if any election results come, market changes, okay, either in a favor or in a negative way. Any budget announcement, again the market reacts. Any statement given by the prime minister or the financial minister or RBA, again the things changes. Economic report regard GDP and per capita income and the future estimation of economic GDP. So this again reflects on the markets. And even the company analysis made by, for example, quarterly profit announcement and future plans announcement, new product launch announcement. So these all things impacts on the stock prices. Now in liquidity traders, so these traders investments and resale of share depend upon the individual fortune liquidity traders. Okay. And liquidity traders may sell their shares to pay their bills. They do not investigate before they invest. So they just bother about the liquidity. And when it comes to information traders, so these are analyzed before adopting any buy or sell strategy. But whereas liquidity traders, they do not analyze it. They estimate the intrinsic value of shares, the deviation between the intrinsic value and the market value makes them enter market. Okay. So they sell if the market value is higher than intrinsic value, vice versa. So they study about all information available regarding particular share or a stock or a company. Then they take the decisions. So this is also basic regarding market efficiency. Now the first theory, that is called random walk theory. Okay, so random walk theory, it was in 1900, a French mathematician named Louis Bachelier wrote a paper suggesting that security price fluctuations were random. Okay, they were random. But in 1953, Maurice Kendall in this paper reported that stock price is a wandering one. They appear to be random. Each successive change is independent of the previous one that we have already seen. But again in 1970, Fama stated that efficient markets fully reflect the available information. So if you see all things, they are random, they are wandering, and the market reacts on the basis of the information available. So if markets are efficient, securities price reflect normal returns for their level of risk. Okay. And FEMA suggested that efficient market hypothesis can be divided into three categories. So they are weak form that we can see in the triangle, the center one, and the semi-strong form, that is the second part of the triangle, mid one, and the strong form. So this all because of the level of information is being considered in the market is the basis for this segregation. And if you look at the diagram here, the first one, if you see the weak form, the center one, so this is called a weakly efficient market. So why? Because all historical information is reflected on the security prices. Okay. And the second one, that is semi-strong efficient market. So all public information is reflected on the security prices. And when it comes to weak form, that is called it is called EMH, the WEMH, weak efficient market hypothesis. Okay. So here only historical information is reflected, but in semi-strong, public information is reflected, which is given. Okay. And when it comes to strongly efficient market, all information is reflected on the price. If you see one by one, so strong image, that is efficient market hypothesis, all information, public or private, okay, is discounted in the current price of final assets. So in such scenario, the EMH posits that there is a perfect market with investor having no edge entirely over the market. Thus, it is practically impossible to make return higher than the market benchmark. That is what strong EMH says about. Okay, and why this happens is it represents an extreme hypothesis which most observers do not expect it to be literally true. Okay, the strong form of the efficient market hypothesis maintains that not only public available information is useless to the investors or analysts, but all information is useless. What about this? Is what about strong EMH? So information, whether it is public or inside, cannot be used consistently to earn superior investors' return in the strong form. And this implies that security analysts and portfolio managers who have access to the information more quickly than the ordinary investor would not be able to use it to earn more profit. That's what strong EMH says about. Now coming to the semi-strong EMH, that is efficient market hypothesis, it considered the most plausible scenario. A semi-strong EMH suggests that all relevant public information is quickly reflected in the price of financial assets. Any information which is coming out in the market, which is available to public. So new information is quickly picked up and processed by market participants so that new equilibrium is created as a result of the new supply of or demand forces. So in this form, the investor can only gain an advantage if they possess information that is not readily available in the public. Okay, and to justify strong image, the tests are used like empirical evidence. Okay, so they use empirical evidence to check this strong form of EMH, and in semi-strong form of EMH, they use empirical evidence. Same thing. Okay, so when we look at Fema, Fisher, Jensen, they have given this run theory and all. And in semi-strong form, okay, so security prices fully reflect all public available information. Okay, and the price not only reflect the past price data but also available information. This is the combination of past data and the available information regarding the it's like, for example, the earnings of the corporate, that is the public available information, dividend what they have decided, bonus what they have issued, right issue, merger, acquisition, and so on. This is all as a public available information which reflects on the stock prices. And when we come to the weak EMH, okay, so here it's all about the past data, we know. So future price cannot be predicted by analyzing the price from the past, that we all know. But in technical analysis, it differs, and here it differs. So everyone has the access to the past prices. You can check it. You can easily access them. So even though some people can get these more conveniently than others, liquidity traders may sell their stocks without considering the intrinsic value of the shares and cause price fluctuation to the market. So buying and selling activity of the information traders lead the market price to align with the intrinsic value. So here they use filter rule to test it, and they use run test. That is, for example, if a coin is tossed, it might, for example, if I'm tossing the coin for 4 times, you can say it might happen head, head, tail, tail. Okay, that is all run test that you have studied in your statistical thing. So that is used. And again, serial correlation is also used to calculate the past data and that impact. So these tests are run to calculate the weak EMH.